Welcome everyone. A waddle update. We've got some volatility, Drew. The VIX Index, if you explain, the VIX Index is at a 12-month high. Trump is sending lots of shockwaves through markets.
And it's not something we shouldn't be expecting from the last time he was in power as well. I think they say that
markets just go up, Drew.
Volatility is the price of admission when it comes to equities. I think that's like one of the most. That's like one of the most common sayings. I did have it saying. I had to take that, and it's stolen from many other people. Yeah. But I mean, it is. And what we're talking about is buying an entirely diverse range of companies that are operating and innovating and changing every day. But they're also revalued by the market every single day. I mean, how else can you explain why Tesla is now worth 50% less than it was in December? The volatility spread everywhere. That could be more personal and sentiment driven given what's happening with Trump. But I think we have conversations with people all the time. And one of the most common things I kept hearing was we've been doing it ourselves for the last 3 years and we've done incredibly well. All 4 years we've been doing it ourselves. You know, we've been buying ETFs. The markets are doing well. And the first thing you and I both think about, I know, is we've been in completely extraordinary conditions. Every time the market's fallen more than 10%, it's gone back to an all-time high.
Quickly.
Incredibly quickly. And this is I'm not going to say it's no different to the last one because neither of us really know. And I'm sure anyone that says they know what's going to happen next is also making it up. But there is the risk that corrections are sustained and they don't rally as quickly as they have in the past. And that is something we've experienced for many times during both of our careers.
Yeah, it's just not in public markets, but other asset classes that have risen and risen and risen. You know, it's been, we covered this in the last podcast, but it's been a real momentum market post GFC. You know, so we're kind of 15 years in this momentum market where if you have a look at any chart,
just goes up to the right,
up to the right, right? Which we know that. That can't sustain itself over a long period of time. And markets are just a reflection of the underlying companies, and the underlying companies need to be driving profits and growth.
And you were talking about the VIX Index. So I think that you asked me to define it and then I blabbed on it and tried to avoid defining it.
Yeah, I thought about it.
I believe like the actual measurement of it is like the spread of options that are predicting where the market's going to go in the future. And as that spread of people expect the market to go higher and lower expands, so if more people are expecting to go lower, the VIX Index increases exponentially or can increase.
Yeah.
I think generally it sits around 8 points or 8 or 9 points.
27 today.
Is it 20? So it's like 2 to 3 times the historical average in just a few short weeks.
I think that, the problem with the VIX Index is it shows, all the fear index in a way. It shows today's fear. It doesn't show like fear tomorrow's. So, it's always, the VIX Index is up, well, markets are already down 50%.
Yeah, it's too late. It's not telling, nothing's a predictive indicator. It's telling you what everyone feels already, not what's going to happen next. And I think it's something that it's been historically low volatility for the last 3 or 4 years. Part of that was the support of central banks and reasonably supportive government. And then the re-entry of Trump and basically any comment he makes at any point, talking about tariffs, are they on, are they off? It's basically inserted a whole heap of volatility that's got, I was looking at some of the big areas of the market, the NASDAQ, so the tech-heavy US index is down 7.5% from its high, its high was this year anyway.
Sure.
The FANG index, so the big Microsoft, Apple, Facebook, all those businesses down 14%. The ASX has now fallen 4.5% for the year, having peaked about 8,600. It's closing in on, I think, a 10% correction.
That's about 7-8, yeah.
And we tend to forget that corrections happen at least probably once every 1.25 years or so.
Sure. Maybe next episode we can bring up the stats of markets over the last 100 years. And if you start looking at the stats of stock markets, you probably wouldn't invest into them. You know, the fall from top down 10% is, every, you said 18 months or so. 50% falls aren't that uncommon either, right? So if you think about our client, our cohort, which are retirees, they're retiring for 40 years. Yeah. So if you start going, okay, you've got 40 years worth of capital, this portion that's allocated to shares both domestically and globally have these characteristics. Expect it to drop, more than 50% 3 times. Expect corrections of 10%, probably 26 or 27 times. It's kind of interesting to start talking about. I've got a story about diversification. I came straight from a client, and he's a very diversified client, so probably more diversified than most, but still.
And something we're very big on, which is not just diversifying your Australian shares, your global shares, but diversifying a whole heap of income sources to make sure if something like this happens, your portfolio is hopefully not going to be too impacted.
Yeah, so he's a retired medico, been a client for 10 years. We've been a tailored portfolio for opportunities and needs. And, he's got circa $6.5 million and his portfolio's down $80,000. Right?
I was sort of going to say that.
And then he's like, should I be worried? It's worth down $80,000. A good compounded return over the last 10 years. So he hasn't missed all the returns. But, one of the things that might be aware of, it's not a warning, just be aware of ETFs.
Yeah.
If he was fully exposed into Aussie market and US market, he would be down, his $6.5 million would be off $700,000, right?
Yeah.
Once you start losing, it doesn't matter who you are, $700,000, your mindset and your strategy falls out the door.
I need to protect what I have left.
I want to sell, I want $6 million or whatever. Obviously he's quite wealthy. But, you need to think about what real diversification means. And probably right at the moment, that conversation went into what do we do about Trump?
Yeah.
And this concept that being truly diversified is really the only thing you can do about Trump.
Yeah.
As overnight you would have seen tariffs on steel manufacturing has been implemented onto Australia.
Yeah.
Well, there is a company in the US that would do incredibly well out of that. Right?
Yeah.
There's an enormous amount of companies. So being exposed to those companies and those sectors in the US will offset what potentially you would be exposed here. One of the problems that the clients find themselves in, and using a lot of ETFs, is concentration risk. So in Australia, you're exposed to banks and resources. So if you get tariffs on iron ore and steel, then ultimately a larger portion of your portfolio is going to be affected. So you need to start thinking about being a truly diversified client and making sure you've got all these risks that will balance themselves out when someone like Trump is in office and is making changes every single day.
And I think it comes up quite often that whether it's in media or in headlines, that it has to be passive or active, that you have to be index tracking or active. But situations like this will hopefully answer a few more questions around it, which is what do you do when markets are roiled or when they're getting volatile? Yeah. And you have multiple levers you can pull. You're talking about diversification, and that's not just companies and areas, but one is there's a fair bit of information and stats coming out at the moment that show that active managers, so say global equities that are trying to beat the S&P 500, are outperforming something like 70 to 80% of active managers have outperformed in 2025, which all the stats that you usually get are that over the last 10 years, 85% of active managers have failed to keep up with their index. So it may be true, and part of that is probably driven by the momentum market that we've been in. But
changes to a different factor.
Yeah, exactly. And then in different periods of the market, an active manager who has less in Tesla, less in Nvidia, even if it's 8% instead of 9%, has the ability to dampen volatility and outperform, particularly in those times when market themes and trends are changing. So I think that's incredibly popular. And then you also have other asset classes. So we've invested in infrastructure and property, but one in particular that has offered the best diversification, that's gold. I think we've been through conversations on that many times.
We held gold for 10 years. We bought it for currency, which obviously did incredibly well for us. And that we still think it is one of the only inverse assets. Saying that has been very correlated to markets on the way up. And right now, at a record high, people seem to be still buying it because now they're fearful of what potentially could happen.
It looked expensive at $2,000 US. I think that was an all-time high. And now it's at $2,890 US and 4,600 Australian dollars an ounce.
Yep.
Areas that I've talked about, and I think we talk about all the time, that we're getting diversification, is looking at different styles and different companies and different factors within portfolios. So you can talk about alternative assets like private equity, private credit, gold, anything, property, infrastructure, but there's also investing into value companies or investing into Asia. as an alternative. And interestingly, Asia has been actually outperforming, and different parts of the market are outperforming.
China's
the US,
been quite a good market in the last few months.
Yeah.
So diversification is lots of levels, and they kind of go horizontal and vertical in terms of how you truly diversify your portfolio.
Yeah.
The sentiment of the whole market does drive beta. Markets moving up, markets moving down. A lot of these asset classes are what large institutional investors use. That kind of reduces the volatility in the client's portfolio. So I think the market at the moment, clients have made a lot of money over a long period of time. So people might be fearful and go to cash. I don't think it's time to go for cash. I think it's time to keep your cash and potentially deploy it. But we've been through a lot of these markets. And markets do react and provide opportunities, but just be really patient for those opportunities, I think.
And having that approach and the philosophy and the process in place, I think, is key. So we'll always revert back to quarterly reviews, and if something changes majorly, which, I mean, a correction is significant, but it's not a pandemic, a global financial crisis, as far as we know at this point. But going back to making sure our asset allocation is appropriately positioned, that we're going back to where we were if global shares had done well, we're taking profits, investing into parts that hadn't done well, continuing to hold fixed interest, looking for those alternative income sources.
Prudent management of capital.
Which can be hard when the market's done so exceptionally well. You just want to put more into the S&P 500 or in the MSCI because it kept delivering 20%.
We've talked about this a lot. Our job is relatively easy, right? We're just trying to tell clients to sell stuff at a high and buy stuff at a low.
Yeah.
And it's always against the sentiment. We're always the bad guys, right?
Yeah.
We're always saying,
boring, conservative.
CBA at $160 is probably worth selling. I don't want to sell my CBA, When Macquarie was $75, people go, well, is it going to zero? No, it's not going to zero. It's kind of the confidence you get. Now, you make an enormous amount of money over time by selling high and buying low. You just have to have some kind of structure to be able to do that, and that's our quarterly reviews, where every quarter we sit down, look at every investment, think about the size, think about holdings, think about the opportunities, think about the risk tolerance of the underlying client, and what is the portfolio trying to achieve over a long period of time.
And the big other thing I wanted to ask your view on as well, which the big change we've had in the last, probably since the last video went out from us, was that we finally had an interest rate cut. And what do we have to do? Is it time to get out of cash, sell all our term deposits? If rates going back to zero, what do we need to do?
Yeah, I mean, the principle. So Austin Donnelly, which was one of the starts to our business, he wrote kind of 50 books in total. 25 were about treasury management, which 25 are the most boring books you've ever read in your life. But this concept, investors cannot lock in term deposits, and it takes discipline to lock in term deposits. So if someone's offering you 4.5% in a term deposit for a year, and they're offering you only 4.7 for 3 years, 90% of the investing public will take the 1 year. But of course, when the 1 year comes due, the underlying interest rates are only 3 or are only 2. So we were taught, we went to the same kind of Austin Donnelly school, that you would take the capital that you need, work out what your cash flow is or needed over that 5 years, and then make sure you've got cash maturing when you need that cash flow. And on average, you'd run a maturity of 2.5 years. So meaning if you had $100,000, you would have a $20,000 term deposit for 1 year, 2 years, 3 years, 4 years, 5 years. And every time one comes due, you roll another 5 years. Some people will roll that just a 3-year strategy. So split into three, so $33,000 each. But locking in your rates is the easiest way to guarantee it. Rates will drop another probably 50 basis points this year. So what are people doing with their fixed income and cash they've allocated for another source? Probably need to lock it away in some term deposits.
Yeah, I love a good prediction as well. But I think it's going to be a similar story to what we're doing when markets are volatile. which is, as you were saying, to keep diversifying, keep thinking about other income sources, and don't just throw out the term deposits that you had before, but keep thinking about it within a coherent portfolio.
Yeah.
And I think
lower rates should be better for markets.
For the markets, for confidence, for property, for anything that has debt or it's is focused on providing an income. So
from observations from the last one I've seen is property, residential property. I know everyone loves residential property. Is getting absolutely destroyed. We both frequent the peninsula, and historically, I sold one place and bought another one. And when I bought that other one, I looked in all these suburbs, and there was like 3 red dots, right?
Yeah.
3 things for sale. When you go and check them out, this is kind of 3 or 4 years ago. And now you bring up any suburb on the peninsula, and it's just red dots everywhere.
It feels like Hoddle Street. Like it feels like billboards all the way down.
Correct.
Yeah.
So you can basically buy something that's, people won't believe it, but you can buy like 40% from its high, maybe 50% from its high.
Yeah.
Which is unbelievable when you think about real estate and how Australians just love investing in real estate. So if you're a real contrarian investor, pop down to the peninsula and buy an investment property.
We never talk about residential property either.
But you look at areas, and people are always interested in residential property, right? And to make real money out of residential property over the next kind of 10, 15 years, it's not going to be that interest rates go to 0. It's going to be pick the areas. And, the peninsula with land tax, with all these other issues, affordability from interest rates, because people bought them a lot lower, is an opportunity. If we talked about property, it's not on here, the whole Bulleen area in Melbourne is an opportunity because they're carving that thing up with substantial roadworks, extending the ring road around. But when it's all done, I mean, the Bulleen, Viewbank, all those areas are going to be accessible. And we're not saying
it's tomorrow.
You don't want to live anywhere near it. I think it's a 6-year project, isn't it? And if the Victorian government's got enough money to do this. But anyway,
we won't get too political on here, that's all right. And I think if there's one area we're looking at the moment and have been focusing a lot of time, so I think our portfolio is probably for context that while we've had a whole lot of volatility for the financial year to date, so from 1 July, the model portfolio is still up about 6 to 7%, including income. And if you think the long-term average return of a balanced growth portfolio is about 6.5%, that's it's still exceptionally good given we've got 3 months left and we're also just experienced a pretty sharp correction too. So
we offer a couple of years of really good numbers too, right? So it's not we're not giving everything back that we've gained over the last few years.
And the other big focus would be around the alternative space and private markets, which we'll keep continuing to discuss, inform, and hopefully educate clients and have some new ideas to share then as well.
Always been an investor in private markets. You and I have been a heavy investor. There's probably more opportunities for retail investors. It was always their really high net worth clients, and more opportunities for retail investors. And better structured products. So we've been writing some papers in our research firm, Atchison, about how you would allocate to alternatives. What are all the various alternative buckets? How do you put them together? So that's quite exciting for people getting access to some of these opportunities, both in kind of distressed or special situation credit, private equity, both domestic and globally, venture capital, and then in this slightly different bucket, infrastructure, direct infrastructure deals, direct real estate deals is really interesting as well. You got there's some liquidity concerns, constraints, not concerns, but I think you get rewarded extremely well for taking some of that illiquidity risk and turning it into a return profile.
And it's an incredibly good diversifier away from listed share markets. And I think it's on us to keep educating and bringing new ideas to clients.
But that's why people have made so much money in real estate, because they buy an asset, they never think it's worth anything less than they pay for it. They hold it over economic cycle after economic cycle, and then they sell it at the end.
There's no VIX Index for residential property.
There's no Alan Kohler coming on and telling you that your Tesla shares are worth half what they were 5 months ago, right? That's a benefit. Anything else you want to contribute, Drew?
The one thing maybe we'll cover in the next video, which is talking about the Australian dollar, that we're back at 62 cents, getting close to what we talk about as being 2 standard deviations below the mean. But we'll do a separate, I think, session on that and talk about when it's time to hedge, what we think about hedging, because at some point there's a risk the Australian dollar becomes more valuable, and that equals bad for overseas investments held by Australians that are unhedged.
It's been a tailwind for the last 10 years, right?
Yeah.
My wife keeps reminding me that when the dollar was 93 cents or 94 cents, she said, we should buy a lot more of this dollar. So one day it'll be back to 93 and 94, and I can say, hey.
We can go travel to America again for us.
I mean, often a question you get from clients is, should they hold euro and US dollars within their portfolio for what will be, we know that our clients travel a lot, for travel expenses in the next 10 years. It's kind of an interesting...
When the dollar's over $1, for sure.
Yeah, when the dollar's sure. Yeah. Okay, great. We might leave it there. Thanks, Drew. Thanks, everyone, for listening. Any questions, feel free, text, email, reach out to our team. Thanks a lot.